Gold prices in India have surged 24% this year and hovering close to 80,000 per 10 grams. In the past 7 years, it has grown at an annualized rate of 15%. So if you had invested 1 lakh rupees, it would have become 2,66,000, that is almost 3 times. Gold is not only a good way to diversify your portfolio, but gold works as a hedge against inflation as well. But how should you invest in gold? Should you invest in physical gold or buy sovereign gold bonds or gold funds? Which is the best way or the right way to invest in gold? Hello and welcome to our channel 5 Minute Finance by ET Money. In this crisp video, we are going to explore various ways to invest in gold. We'll compare them on several parameters and figure out which is the best one. Let's start with traditional way of investing in gold, that is investing in jewelry. But it is expensive as there are making charges, storage charges, etc. And then there is 3% GST. So given its numerous drawbacks, investing in physical gold is clearly not a great choice. So to overcome the limitations of physical gold, you can opt for the digital route, which includes number 1, digital gold that can be purchased online through various apps. It is basically 24 karat, that is 99.9% pure gold stored in big vaults insured by the seller. The USP is you can invest as low as 1 rupee in digital gold. Number 2 is gold exchange traded funds, gold ETFs. So just like shares are traded on stock exchanges, gold ETFs can be bought and sold on exchanges. Gold ETFs invest in physical gold and stocks of gold mining refining companies. Number 3 is gold mutual funds. Now these can be called a shopping cart of gold ETFs as they invest in gold ETFs. You can invest in most gold mutual funds through the ET Money app, where you can compare all the gold funds and invest in them at 0% commission, that is for free. Number 4 is the government-backed sovereign gold bonds. These bonds are issued by the Reserve Bank of India from time to time. Linked to the price of gold, what makes them popular is the additional fixed interest rate of 2.5% per year. However, with gold prices soaring, the government opted to discontinue the SGB scheme, realizing that rising prices would significantly increase its redemption costs. This decision comes as the second-year issuance of SGBs nears maturity, with gold prices nearly doubling over the past 8 years. So as of now, SGBs are out of the list. One common thing between all these options is that the returns of these options are linked to gold's price, but they differ in availability, affordability, risk, cost, liquidity, and taxation. So let's compare them to find the best way to invest in gold. We'll start with availability. Availability means how easily an investor can purchase it. So in most cases, digital gold, gold ETF and gold mutual funds are readily available for purchase. But SGBs are a bit different. Now these bonds are released after every few months by the RBI, and this buying window remains open for 5 days. Now as of now, the RBI has not issued any series after February 2024. Next, let's compare these options on the affordability parameter. So you can buy digital gold for as low as 1 rupee. Gold mutual funds and gold ETFs are next in line. You have to purchase a minimum 1 unit of an ETF, and the price can vary from 50 to 100 rupees. Gold mutual funds allow you to invest a minimum of 100 rupees. On the other hand, if you want to invest in SGBs, you'll have to buy at least 1 gram of gold. The February issue of SGBs was issued at a price of around 6,263 rupees per gram. So that became the minimum investment. Now when we are talking about such a precious metal, there have to be certain risks. So let's compare risks in all these options. Since the returns of all these options are linked to the price of gold, they all run the risk of fluctuations in the price of gold. Let's look at other than market related risks. If we talk about digital gold, while purity is not a concern, neither is storage. The biggest risk is that the space is not regulated. There is no regulator such as SEBI or RBI to protect your interest as an investor as of now. So it runs a big risk of lack of regulation. That way, gold mutual funds, gold ETFs do not hold any such risk. They are backed by physical gold. They are regulated by SEBI guidelines, don't have storage or theft concerns. Hence, low risk. Even SGBs, for that matter, being government backed, are safe from these risks. Next parameter is costs. In the case of digital gold, there is no storage or making charges, but there is 3% GST. Another major cost is price difference between the buy and the sell price. So if you see on this well-renowned platform, the buy price and the selling price both are different. There is a significant difference between the two. On the other hand, gold ETFs charge between 0.5% to 1% annually, which includes expense ratio, demat account charges and brokerage. Next are gold mutual funds that charge an expense ratio of 0.1% to 0.2% plus the expense ratio of the gold ETF where they are investing. But SGBs are an exception. They don't have any visible expenses. Next, let's assess the liquidity of these options. If gold prices get stuck at some level or if they shoot up, you might want to sell. Hence, liquidity is important. From that standpoint, digital gold, gold ETF and gold mutual funds can be bought and sold quite easily. But SGBs come with a long maturity of 8 years and a lock-in of 5 years. And if you want to sell them before 5 years, you can do so only on stock exchanges where the volumes may be low. So you might have to sell your bonds at a discount as compared to the market price of gold. Moving to the last parameter, let's look at the taxation aspect. Now pay attention here. Let's start with taxation of gold mutual funds. If investments are made on or after April 1, 2023 and sold within 2 years, the entire gain is added to the investor's income and taxed according to the applicable slab rate. Long-term gains, that is, if sold after holding your investment for 2 years, gains are taxed at 12.5%. Next is taxation of gold ETFs. The long-term capital gain period for gold ETFs is 12 months and the tax rate is 12.5% without indexation. Short-term gains are added to the income and taxed accordingly. And as far as taxation of SGBs is concerned, here also the LTCG period, that is the long-term capital gain period, is 12 months and tax rate is 12.5%. Short-term gains are added to the income and taxed accordingly. Coming to the 2.5% interest income under SGBs. It is taxed as per your slab rate, but if SGBs are sold at maturity or redeemed to RBI, the gains are tax-free. So we have compared different options on several parameters. It's time for the final word. Which option is the winner? Well, physical gold and digital gold have many drawbacks. So if you want to invest for the long term, SGBs could be a good option. But as of now, as we have discussed, the Reserve Bank of India has not released any plan to issue SGBs. So currently, gold funds and gold ETFs seem to be the better options. They offer the necessary liquidity, you can make tactical allocation through them, rebalance your portfolio. These are even suitable for those looking to make smaller contributions. And with this, we come to the end of this video. Share it with your friends and subscribe to our channel for more crisp and insightful videos.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.